Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The hurried introduction and launch of GST on the midnight of 1st July 2017 by the President of India through the 101st Amendment to the Constitution was certainly a historic move, but it is also one where the fears and apprehensions of the ordinary taxpayer were overlooked. Such a major move needed to adhere to the principles of a participative democracy and to be sensitive to the concerns of the smallest of the taxpayers. But that was not done. The mute, small taxpayers with no say found the GST law and its compliances to be complicated and onerous, and that's what they had feared. They doubted the government's intentions and they were wary of the move. That was reflected in their subsequent reluctance to be even registered under the GST, and they preferred to operate below the radar rather than be registered and be subject to the rigors of the harsh GST code that was formulated. The GST code was a path-breaking law that would change the business parameters and paradigm for many, especially the smaller ones, and hence the kind of fear and the apprehension that they had. The government, however, persisted and bulldozed the rollout of the GST despite its tardy acceptance by the small taxpayer in particular, as was reflected in the initial slow pace of registrations of the taxpayers under the Act. The GST collection thereafter grew in tandem with the rising registrations and the strengthening of the government's anti-evasion framework. The GST collections for the 9-month ended March 2018, which was the very first year of the law, were about 2.19 lakh crores. That was for 9 months. It rose to rupees 5.18 lakh crores in the very next year, which is 2019. It then went up to 10.19 lakh crores in 2020, then to 11.36 lakh crores in 2021, and finally, we recorded a record GST collection of 14.9 lakh crores in the recently ended financial year 2022. The growth in GST collections has been independent of the GDP growth rates of India, and thus, while the economy contracted by over 7% in financial year 2021 because of the COVID lockdown and the consumer spending dipped, yet we saw a growth of over 11% in the GDP collections that year. That was surprising. With the Indian economy recording a recovery of sorts in financial year 2022, touching a growth rate of about 9% to almost reach the pre-pandemic levels, it was perhaps the first complete year of a stable GST administration collection in India. The highlights of the GST collection in financial year 2022 were something as follows. As against a GDP growth of 9%, the GST collection shot up by about 30% to touch a record figure of 14.9 lakh crores, in which the centre's share was about 6.19 lakh crores, thus exceeding even the revised higher budget collection target of 5.7 lakh crores. It was far beyond their estimates. Further, the average monthly GST mop-up stood at 1.23 lakh crores, recording a low of 92,849 crores in June and an all-time high of 1.42 lakh crores in March 22. The Finance Ministry said in a statement that economic recovery together with the anti-evasion activities and measures of the government, especially action against the fake billers, have been contributing to the enhanced GST collection that we saw in financial year 22. It said that the improvement in the revenue is also due to various rationalisation measures undertaken by the GST Council to correct the inverted duty structure. That was financial year 2022. What about financial year 2023, which is going on? The CBIC chief, emboldened and encouraged by the rising GST collections, now predicts that the CGST, which is the central share of GST collections, is likely to increase by 20% in financial year 2023, with the expected total GST collection to cross 16.5 lakh crores. In that case, the GST share of the centre could exceed its budget estimates by almost 4 to 5 lakh crores. Though the CBIC chief says that the GST collections in financial year 23 will get a boost from improved compliance and a rebound in economic activities, the expected growth in collections is far in excess of the GDP growth rate of the Indian economy, which is expected to be in the range of 7.2% for the financial year 2023. As against an average monthly GST collection of 1.23 lakh crores in the previous financial year, which is the year ended 31st March 22, it is expected to cross 1.35 lakh crores in the current year, which is the financial year 2023. The CBIC head says that the recovery in the domestic economy, including in the services sector which was affected due to COVID, and improved compliance would help maintain the buoyancy in the GST collections during the current financial year. Incidentally, while the GST collections are expected to rise at a brisk pace, the CBIC does not see much of an upside in the excise and customs duty receipts this year. Excise duty collections are expected to dip by 14% to fall to rupees 3.35 lakh crores this year, as against rupees 3.9 lakh crores last year. With dark clouds hovering over international trade because of the Ukraine war, custom duty receipts are expected to grow by just about 7% during the current financial year, as against GST going up by more than 20%. In order to meet its collection targets, the CBIC will increasingly focus on the scrutiny of GST returns to verify compliance. Thousands of cases have been identified for scrutiny of the GST returns. The CBIC also proposes to commence a quarterly scrutiny of the current GST returns of taxpayers to ensure compliance and tax payment on a concurrent basis. The CBIC is looking for consistency within the GST returns filed by the businesses with regard to input supplies, output supplies, input tax credits and tax payments, because that should be a common uniform pattern generally, and notices are immediately being sent in case any mismatches or anomalies are found in them. Advanced data analytics are being extensively used by the CBIC to plug tax leakages and shore up the GST collections. The normal principle is that the GST collections should grow in tandem with economic growth and consumer spending in an economy. But that's not so in India at present. These are still formative years of rollout of GST as it seeks to cover more and more regions and more taxpayers, so as to widen the taxpayer base and increase tax collections. So it is still a formative time according to us. It is also that the gestation period is going on where tax evaders are being spotted and being brought under the GST fold. It is also that build-up of time when the extensive data collection and analytics of the government are demonstrating that if you are liable to collect and pay GST, you will not be able to remain hidden and evade taxes or evade compliance for very long. You will be spotted, you will be punished, and you will be brought into the GST fold. This is what explains the mismatch in growth rates, with GST collections rising at a much faster pace as compared to the GDP growth rate and consumer spending in the economy, as is evident from financial year 2022, when GST collections in India grew by 30%, as against a 9% growth rate recorded by the GDP, by the economy. Or you take the financial year 2021 also, when the GST collections grew despite a contraction of the Indian economy because of the COVID pandemic. The economy contracted, but GST collections that year went up by more than 11%. But this mismatch that we are talking about cannot continue for very long, and there are reasons why the GDP growth and the collections this year may not grow to the extent which are being estimated by the CBIC chief. And what are those reasons? The first one, the GST collections will rise, aided by the rising inflation, which is expected to remain elevated throughout the current financial year. However, such an increase in GST collection gives a false notion of improvement in collections, and it must thus be ignored. If inflation rises by about 10%, so will be the case of GST collection. It will rise in proportion, even if the volume of consumption is the same as in the previous year. What matters is a real increase in collections and not one because of an untamed inflation. That is just cosmetics and not the real story. The second factor, amidst rising inflation, unmitigated unemployment, and other effects of COVID, household incomes and savings have fallen, and so has consumer spending. The recent trends show the unwillingness of consumers to resume spending on discretionary items. Until that does not pick up, there will be no real jump in the GST collections in India. Further, the government has come down on tax evaders with a very heavy hand, giving them the harshest of punishment, including imprisonment of the taxpayer as well as his consultants and chartered accountants. The incidence of tax evasion is reported to have come down significantly because of these measures, and thus the one-time buoyancy in tax collections due to the nabbing of tax evaders will be certainly missing or very subdued in financial year 2023. The system has certainly become far more effective in spotting GST evasion, and the incremental benefit of improved collections because of better compliance is petering out. Further, apart from the reluctance and inability of consumers to spend, the production cuts because of supply disruptions now caused by the Ukraine war will dampen purchases. It will dampen actually production and so purchases, and thus the GST collections will also be dampened. Higher exports are expected during the financial 2023 from India, but that will largely not add to the GST collections. The possible reason why GST collection could increase, which we would not know at present, but the CBIC chief does, is if the government plans to tinker with the GST rates such that it abolishes the GST rate of 5% and brings most of the 5% items under the 8% bracket. In such a case, GST collection will shoot up without any incremental increase in consumer spending or purchases. Such a move to us is highly avoidable at a time when the common man is already super burdened by rising food and fuel prices amidst scarce employment and livelihood. Since the GST administration tends to be pro-revenue and anti-taxpayer most of the time, and the government too has very often been indifferent to the economic woes of the common man, of the common entrepreneur, we would not be surprised if it does, which is it abolishes the 5% tax bracket and most of the 5% items are then taxed at the 8% rate only in order to increase the GST collections. We think that if that happens, it would be a regressive move. It would be badly timed because this is not the time to burden the taxpayer, to burden the common man with further collection of taxes that we are seeing. This is Akhilesh Bhargava signing off till we meet again. Namaskar.